What could trigger the next credit crisis in 2026? AI underwriting, alt data, surveillance pricing, or buy now, pay later? Matt Komos, good to see you.
Hey Phil, thanks for having me back. Good to see you as well.
What are you seeing?
There's been some stuff out in the media and even from different central banks with concerns about underpriced credit, meaning, the pricing of credit doesn't correlate to the risk of that credit. And what happens, right, is as the labor market continues to struggle, here specifically in the US, wages haven't kept up with overall inflation, which is a real problem because now my dollar doesn't go as far. And so what happens is consumers, when they start having choices to make, am I going to pay my, credit card bill or my auto loan, right? And it depends on their situation, or put food on the table. Consumers are going to put food on the table, right? And so there is the potential, I think, for, I don't know if it's going to be a full-blown crisis. I think buy now, pay later plays a part in this, right? Because I think it's masking some of this risk because it's helping consumers augment their income, where some consumers are using it to augment income. So I think it's, the reality is there's a lot of pressure on consumers. That income inequality gap is widening. And so it's a matter of what's going to happen. And I think what tends to happen as the macroeconomy slows, lenders actually tighten up, right? And so for some consumers, they could see their credit line slashed, or they might see, that loan that they might have got yesterday isn't available anymore. And that those types of loans might be helping bridge a gap until a new job or something else. And if those aren't available, I think it's going to be a challenge for consumers.
So, Matt, why aren't we seeing those tighten up now? Like, it just surprises me. Like, it's almost like there's always a new type of credit available to fill in that gap, to bridge the gap. Like, I just, I'm just waiting for the shoe to drop.
Yeah, well, I think the reality is many lenders are trying to figure out what consumer needs are there that need to be served. Now, the challenge becomes when you've over leveraged that consumer, or you become that kind of the bridge isn't really a bridge, it's just filling in income for a
Mhm,
while. Ultimately, it comes back to consumers' ability to pay.
mhm.
And if I don't have a job, it's going to be hard for me to make payments, or I'm going to have to dip into my savings, right? Or if my wages aren't keeping up and I'm taking on more debt, that can put a consumer into a challenging position. What I think a lot of lenders, fintechs, what they're trying to do is, again, they're trying to serve a consumer need, and they're trying to evaluate. That's why they've brought in things like alternative credit data, why they're using AI to really get a better understanding of the potential risk of the consumer, so that they can make that right loan. And that's why you see kind of that, you'll see tightening up, as the macroeconomy shifts, lenders start kind of battening down the hatches because they're worried about not only the new consumer that they might think about giving a loan, but their existing portfolio. How's that going to perform?
So, Matt, I'm going to walk through some numbers at you. Total revolving debt, according to statista.com, for 2020 was 1.015 billion. So that's 1.015 trillion. And then it was paid down, during COVID, right?
Yeah. Yep.
And now in 2024, this is not even 2025 numbers, it's at 1.34
Yeah. So
trillion.
30. So yeah,
We're like a 30% increase. That's not
30%
even
increase.
2025,
Right. And
right?
and then think about, that's not even relative to the pay down that happened, right? That's relative to pre-COVID,
Yeah, right.
30%
You're right.
increase.
It's a good point. That's a really
Yeah.
good point.
Yeah.
So, but I mean, I guess what I'm missing is wage growth has not happened.
Yeah.
You, student loans are now required to be paid back.
Yep.
I mean, I mean, and Trump administration just pointed out that they're going to start garnishing
Yeah, I saw that. Yeah.
wages for student loans, and that's a national garnishment. And what I mean by that is there's states that do not allow garnishments,
And it's going to
but
supersede
it's
that.
going to supersede
Yeah.
that because it's a
Yeah.
federal loan.
Right.
Okay. And I just don't understand. Like, no one can, wages are not up 30%,
No.
right?
Well,
Wait, but
yeah.
but but that is garnishment. I just am trying to figure out why the drop and why the purse strings haven't been pulled on these consumers. It's got to happen. What am I missing here?
Well, I think you've seen some of it in certain areas. If you look at some of like recently released kind of statistics, right? Some of the growth has slowed in originations and some of the like installment loan products,
Mhm.
though the balances keep growing, right? I think, that revolving debt growth is an indication of consumers struggling actually.
Yeah. Oh, yeah.
It's them, kind of augmenting that income that isn't keeping up with the cost of everything.
Yeah.
So I have a real concern about, the fact that yes, the revolving debt is growing, wages aren't keeping up. This is pointing to, at a minimum, I would think kind of a crisis in kind of the near prime and prime segments.
Mhm.
Subprime consumers are kind of they're always in a challenged environment, right? They're struggling on multiple facets, whether it's keeping up with bills and kind of almost in their own mini recession on a regular basis.
Mhm.
But that near prime and prime consumer, I think, and it could even stretch up to super prime where we start seeing scores come down because consumers just can't keep up with their payments. Lenders are paying attention to this. I can tell you that, right?
They
So
are.
even though it
Well,
doesn't feel,
you're in the
yeah,
trenches with these
yeah,
lenders. So they're noticing
yeah,
and they're pulling back in some. I want to give you one more stat for you to opine on. Car loans, like subprime borrowers on car loans. At the height, we're talking 1997, 6% were behind, at least 60 days behind. It's the highest it's ever
the
been right
tides
now,
that they're going, yeah.
2025, 6.65%. The car loans are not 3 to 5 years anymore. They're
No,
pushed out like
84
7.
months.
Oh, yeah.
Yeah.
I mean, it's like, so imagine a car that's old that you're buying for $25,000 and you're overpaying it to begin with. You're
And then you're
paying
underwater for,
you're underwater. You can't do
yeah.
it. They break down. I mean, we're the highest subprime, 60 days late wage growth. But guess what? These buy now, pay later buttons are on every checkout.
They're everywhere. Yeah.
I just can't figure it out.
This trend of auto delinquency has actually been going on for over a decade. So
Hmm.
when you look at the growth of delinquency, and it's not just in subprime, it's happening. We
Everywhere, huh?
note it specifically in near prime and prime, and it's the cost of cars has gone up exponentially, the
Mhm.
cost of owning a car, right? Insurance,
Oh, yeah.
right?
Oh,
I mean, so this is all pointing to, in my mind, a breaking point, right? I mean, at some point, a consumer has to throw up their arms and say, I can't do this anymore, right? I think that we could see, kind of delinquency start ticking up in other areas, credit cards. We've seen it in mortgage. We actually started seeing mortgage delinquency starting to go up. So in my mind, there are signs that things are starting to crack. Now, the buy now, pay later lenders, they're trying to push a product, right? I mean, they're
yeah.
they're so in their mind, what they're hoping for is that they're near the top of that payment hierarchy,
Mhm.
right? So, a lender is banking on a consumer kind of ranking their debts and how they're going to pay them. But in reality, especially until those buy now, pay later lenders start reporting to the bureaus, if I'm
Mhm.
a consumer, why would I pay that loan? Like if I'm
I know.
stretched to pay my auto loan or my buy now, pay later loan, I'm paying my auto loan all day because
Yeah.
that's getting me to work, that's getting me to job interviews, that whatever the case is. So yeah, I think it'll be interesting to see how that the buy now, pay later industry over the next year or two, kind of some of the performance of those loans. I mean, not that long ago, I think it was a firm, it was reported their delinquencies were much higher than expected. And I think that,
Big surprise.
yeah, well, expected to what they reported out to
Right.
Wall Street, of
Oh,
course, right?
right.
But this it's funny because, I don't know, probably 5, 6 years ago when these products started becoming a thing, I remember saying like, I don't think they're that great. And I think that there's a lot of hidden risk going on. And it's a
And it's,
reflection,
yeah.
yeah.
No,
Well,
go on.
it's a reflection of similar to what we were talking about. You see this what is known as a K-shaped economy, right? So you have people that are making a bunch of money and they're fine on their credit, and they're the ones using buy now pay later for convenience. Then the other side of the K is this group of consumers that are struggling, trying to keep up with their auto loans, and they're using buy now pay later to augment income, right? Two very different use
Yeah,
cases of
right.
the same product. And so if you're not really good about underwriting that risk, trouble's going to come, so I definitely think there are some cracks showing. Now, what I will say is, as I mentioned before, lenders are aware of this. They're on top of it, and this is why they're using alternative data. They're trying to evaluate as much data as they can to help understand the risk of the consumer. You know,
But Matt, don't you think that, I mean, like when you say that using alternative data, it's in their best interest to lend money,
but
right?
it's also in their best interest to get that money paid back.
Well, for
Yeah.
sure, for sure.
Yeah.
But sometimes, the right hand doesn't know what the left hand's doing. I lived through the mortgage crisis.
Yes.
I saw these like 90% stated income negative amortizing loans
Right.
that these banks were pushing, but they wanted to get
Yes.
paid back, but it was amortizes, it was securitized on Wall Street.
Oh
It
yeah.
just,
Well, at one point I mean, that's so the difference there, right? Though is a great example. I mean, they weren't holding the risk.
right. I know,
So,
but,
so,
but don't,
you know,
but like what I guess what I mean by that is the people who are driving these marketing machines of a firm and Klarma and all this, or fill in the blank, like, these credit card companies that are looking for alternative data. Don't you think inherently what they're looking for is reasons to approve, not reasons to not approve?
well, ultimately, yeah, they're trying to grow their customer base. I mean, a
Right.
lot of them have, investor IRR thresholds they're trying to hit
Of
and
course. They they
whatever,
they they don't want to they don't want to report to Wall Street that we're missing our numbers.
right.
It's a bit of like you're not rowing in the same direction.
However, I will say that in working with many of these lenders,
Hmm.
they're trying to do smart growth. So
Hmm.
it isn't just about growing at all costs
Hmm.
because you would lose your shirt. I
Hmm.
mean, that's just the reality of it. It's about picking those best risks or
Hmm.
the likely to best perform consumers and knowing at the margins where you have to tighten up or where you're willing to loosen up and let that consumer in. And so while it might feel like yes, from a marketing standpoint or a growth perspective, they just want to get as many loans into as many hands as possible. These guys are constantly evaluating their decision making, the marketing campaigns, who they're bringing in the door, their underwriting. I mean, it's this iterative process that is ongoing.
Yeah, I'm sure.
And that's why things like AI actually help because it makes it more efficient.
Yeah.
It can actually automate some of the processes and help with the analysis. And, but it's one thing for consumers to be sure of. There are still humans in the chain that are overseeing all of this, right? But I wouldn't be surprised, honestly, if in the next few months at least, we start seeing lenders really start tightening up.
So,
And
so tell me what that looks like. When you say lender start price light tighten up, is like could be the precursor to a 2026 credit crisis, right? Like where it's really tightening up compared to what we know now. Because we've seen loose credit since the housing bubble, right? They tightened up and then it's getting less and loose and loose and
it's
loose.
been
And loose.
loosening up. It tightened up a little bit in
Yeah,
COVID, right? Because of
right.
the uncertainty. And
Well,
then
but then it opened up like
but
no
then it opened up a
business.
lot.
Like it
Yeah.
it it opened up by an order of magnitude with these COVID relief loans for businesses. I mean,
Well, yeah, PPP loans
oh
and
my gosh, like that was,
well,
but
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 that's
that's a
government
whole different
backed.
world. That's
Yeah.
not credit related. So
That,
what does
right.
this credit crisis look like if it does happen in 2026?
Yeah, so I think in my view, what I think is we'll continually see and unless the labor market shifts, because as we were talking, right, there's a lot of companies coming out saying they're not hiring in
Yeah.
26,
Yeah.
right? And there's plenty of consumers out of work currently, right? So assuming the labor market doesn't shift, I think we're going to start, or continue to see consumers be squeezed. if inflation continues to go up, which it hasn't really shown signs of abating any, recently, consumers are going to have to start making some hard decisions on what they're going to pay and what they're not going to pay. And as I said, I think it's going to creep up through the risk spectrum. So you might start seeing some near prime, some prime consumers start sliding down because they aren't able to keep up with all of these costs. But I've been very much in the same boat as you of like feeling like, when is this shoe going to drop? Because I would have expected it maybe 6 months ago. And there was like unbelievable sales on Black Friday this
I know.
year. However, I mean, some of that is because it's their sales, right? So
Yeah, right.
they're probably buying some of the necessities in addition to, gifts. And, it's hard to, like, you can't peel apart all those
Yeah, right.
retail numbers, but that was shocking to me though. I was thinking, oh, it's going to be subdued.
Yeah.
And in fact, right, it's because people were getting deals. So they feel like they got to take advantage of it. So I think by the middle of 26, we're gonna see delinquencies going up. I think we're going to see lenders tightening up, meaning they're going to be extending less or making credit less available to consumers, especially in credit card and personal loans. Um, and it's going to be a matter of like, how does it turn into a recession, right? I mean, there's a lot of different components of what it means for a macro economy. The reality is the average middle class consumer, which is shrinking day by day. I mean, they're the fuel to the economy. I mean, the spending that the average consumer does is what makes our economy go. So by taking away potentially like safety nets and programs, right, then you have like healthcare costs that are likely going to hit a lot of. I mean, there's
Oh,
just a lot of stuff
outrageous.
going on that consumers are going to unfortunately have to start making some tough decisions.
Matt, last question. What do you think the probability is as a percentage where banks are like holding, not just tightening, I'm talking a full retreat in
Yeah,
2026? Like, what's the
yeah.
probability?
I,
50,
I,
50,
No, on
25,
a full retreat, like a full
full retreat,
breakdown of the credit system, I would put that at less than 10%.
less 10%. Great.
Yeah, because the reality is there are a lot of consumers in that super prime and prime plus, those higher credit score areas. Now, you're going to run out of available consumers at some point, but lenders will still make loans available to those least risky consumers, but
Mhm.
then they'll start tightening it up from the bottom up.
Matt, thanks for joining.
Thanks so much, Phil.